Hello there, Hector Deville here. Welcome to a new video. Today we're gonna step a little bit deeper into, support and resistance trading, and more specifically, I'm gonna be listing what I call the 10 commandments of support and resistance trading. Okay, these are basic principles that you actually is the core of the core rules of support and resistance trading. You need to know by heart these 10 lines here that you are seeing right now on your screen. Actually, they are so important that you may actually want to write them down on a sticker and just just place it next to your monitor. Okay, stick it next to your monitor, to your trading desk, somewhere where you can always take a quick look and check whether any particular setup that you may have found actually fulfills all these different commandments, all these different rules. All right. Again, this is crucial, guys. This is going to be a long, thick, and dense video, but trust me, it's one of the most important in the whole module. All right. So again, please do take notes all along. You may want to review it twice, and again, next time you go into your charts and you define different levels of support and resistance, please go through this list just to make sure they actually fulfill, all right, these 10 commandments. All right, let's get going. Okay, first of all, you need a market bias. This is a universal principle, guys. You cannot make money when price is has no clear directional bias, or when it's not really showing any type of color, all right, either to the upside or to the downside. If you are seeing market confusion, meaning price flip-flopping sideways, your best bet is to not take any trade, to not search for trading opportunities. Now, I don't mean to say here that you actually need a full trend, all right? That's not the case. Also, I don't mean to say here that you need to trade in the direction of that market bias. That's not the case either. For example, if you have an uptrend, you have a clear directional bias, in this case to the upside, so you can search for either continuation moves or reversal moves. All right, but at least you can define the chart. Okay, you can structure the chart as an uptrending bias. Okay, it works it works as a work frame, just as a painter needs a canvas, okay, to conduct his or her work. Well, you need some sort of a directional bias in order to search, again, either for continuation or for reversals. In the other hand, let's assume price has been entrapped within two horizontal boundaries. Okay, basically we have a range, and price upon quite a while being zigzagging up and down, flapping sideways, price is falls back somewhere in the middle area of the range. It's absolutely impossible, guys, trust me here, absolutely impossible in the long run to take sensible trading decisions once price is located in a no man's land, which is actually the second commandment. I'm going to be talking about no man's land in a minute. It's absolutely impossible to make money there, again, because if the market as a collective, okay, as a whole, is not really showing any true color, is not really showing, or is again showing market confusion, it just doesn't know where it wants to go. If the market doesn't know where it wants to go, how are you, as just an individual trader, how are you going to position yourself in any given direction? All right, you are basically flipping a coin. Okay, it's a 50-50 chance. And again, we don't try to gamble our money away. All right, we trade whenever we find an edge, or we believe we have an edge over the market because we have an extra piece of information, and therefore we can take sensible trading decisions. Well, you cannot take any sensible trading decisions there because you have no edge over the market. However, if price was entrapped within this range, all right, okay, and then price moved all the way up to one of the extreme boundaries of that range, there you have an edge over the market. How is that? Because price is located at a decision taking level. You know that price is bound to react off that level, again, either for a reversal or for a breakout move, but at least you know that price is bound to go somewhere. From this point, okay, the move should be imminent, and it should happen in momentum, because this is a decision taking level. This is not here. If price is not anywhere now on a no man's land, guys, in the middle of a range, is price at this point is at a decision taking level, and therefore you can begin searching for trading opportunities, either again reversals or breakout, but at least you know that the move is going to be imminent and it's going to happen fast, all right, in momentum. You don't have that extra piece of information here, and that's why I say that you cannot gain any edge over the market there. You can indeed there. That's a correct, that's a, let's say, an appropriate area to search for trades. All right. So as you can see, whenever I mean that you need a market bias, I don't mean that you need, I don't mean to say that you actually need a trend. You can be entrapped within a, price can be entrapped within a range, all right? But at least you have that market bias. You know that the move is about to happen, and it's about to happen in one directional bias. Not like in here. Not like in here. In here, price can keep on move sideways, you know, on and on and on. In here, it's not going to happen, because price is at a decision taking level, and the market needs to position itself into one given direction very soon. All right, that's what I said. That's what I mean by having a market bias. And well, this pretty much links to the next commandment, which I already mentioned before: avoid trading in no man's lands. What is a no man's land? Well, it's an area that's facing resistance above, immediately above, and support immediately below. Basically, it's a congested area. I usually picture, and that's also linking with the next commandment, I always picture a chart as a highway. All right, you can have highways totally congested, loaded with traffic, or highways completely free of any traffic. Now, let's assume levels of support and resistance are, represent the traffic jam. All right. If you are driving in a highway with plenty of cars around, with plenty of levels of horizontal or diagonal levels of support and resistance, both above current market price and below current market price, it's just a pain to drive or to trade in those charts. Okay, you don't want to trade in those market conditions, just as you don't want to drive on heavily congested highways. Okay, you want to search for areas free of traffic. Well, a no man's land is an area of the chart where you see, let's assume, I don't know, price is somewhere in there, and you have plenty of levels of resistance above and plenty of levels of support immediately below current market price. That's a no man's land. It's a level where price is basically located in areas where the upcoming next move is rather confusing. You are not pretty much sure where price might be headed on the upcoming future, and therefore, again, you don't have a market bias. Now, let me give you a few examples on actual charts. Right, let me show you a typical example of a no man's land. Okay, I was just analyzing the New Zealand dollar against the Swiss franc on the weekly chart, and well, take a look at what's going on as of lately. Let's draw some lines, some levels of support and resistance on this particular chart. First of all, let me zoom out a little bit. Let's see what we can find here. All right, well, first of all, we can find a trend line that was broken a long time ago, so we can delete that swell. Now, let me zoom back in a little bit. Okay, we also had, or used to have, an uptrend there that also got broken. As you can see, now we have the new outer trend line should be that one, but I cannot really draw it, or I cannot really, this is not really a significant trend line because price is still not made a new high there. All right, so while I can draw that trend line, still price is not really confirmed the continuation of this former move by taking out by making a new high, taking out the previous swing high in that trend. So this outer trend line is a little bit weak. All right. Not only that, price is also, playing, toying around, bouncing around that trend line for the time being. So, no clear reading there. Also, if we draw some horizontal lines, as we mentioned already before, price is unable to break above that particular level. All right. So all in all, what do we have? Let me take this off just to make it cleaner and zoom in a little bit more. So what do we have? Take a look at the swings in price. Lower swing high there, price making a lower swing high after having been scoring higher swing highs, higher swing lows, higher swing highs. Well, now it makes a lower swing high and a lower swing low. But then it comes back all the way up and it takes above that level, but it fails to, continue with the trend. So all in all, we have price simply zigzagging up and down without any clear directional bias. And as I was mentioning before, we have that outer trend line there, a little bit of, of a weak trend line, but a trend line nonetheless. And also we have resistance above current market price with that final swing high there. All right. So all in all, what do we have? Price is in a no man's land. At this point of the chart, at this junction, there is no clear market bias. Okay, there is plenty of traffic in this highway, plenty of traffic there with, again, resistance above current market price, support below current market price. We also have support on this previous swing low there. Price is in the middle of that swing high and that swing low, and again with very confusing zigzagging formation, basically moving sideways. Okay, as you can see, price has been moving sideways for quite a while, simply up and down, up and down, up and down, etc., etc., just to end up at where it was before. All right, entrapped in horizontal levels of support and resistance, that trend line we saw before. All in all, plenty of traffic here. You don't want to trade in that market conditions. So, course of action, just mark the swing high, mark the swing low, and until price gives way, all right, into either direction, you don't want to trade here. Just check this out. Let me zoom out once again. Remember when I said before, you want to drive in, highways free of any congestion, okay? Or meaning you want to trade in charts where there is no, there is no jam or plenty of levels of support and resistance flying around both above and below current market price. Well, if we wait for price to actually break, whoops, sorry about that. Just let me be accurate with my trend lines. You don't want to be sloppy with your trend line, guys. You want to be rather accurate with them. All right. So, all right. Once price, check this out. Once price actually gives way in any given direction out of this or away from this no man's land, do you see how there is no further level of support or resistance anywhere in there? All right. Once price actually gives way in any given direction, we have plenty of free room both above and below that congestion area, so we can certainly search for our trades here or here. These are the areas where you want to search for trades. All right? These are the areas. As you can see, there is nothing above and nothing below. So once price breaks above that level, chances are it will cruise through, it will cruise forward, since there is no further, let's assume a breakout to the downside, there is no further level of support anywhere below that may stop price, that may stop price on its tracks. Since there is no support level, price, whenever the breakout takes place, it will fall freely in momentum. All right, and the same thing to the upside. That's the type of market scenario you want to trade. Trade in areas free of any traffic. Avoid areas with heavy traffic going on in there. Okay. All right. Let me give you another example. Canadian dollar against the Swiss franc, weekly time frame. current market price, right there. Let me zoom out a little bit. As we can see, we used to have a downtrend. Oops, sorry about that. A downtrend in there, but it's obviously been broken. It's been broken for quite a while. We also have a level of support and a level of resistance there. That level of resistance is quite far away from price, so no need to draw that. And this level of support, well, has been broken quite a number of times, so it's not significant anymore. You need to remember that the markets have short memory span. If a level of support and resistance has been broken twice in a row, most of the traders simply take it out of their respective charts, and therefore it's significant no more. We have one final level of support and resistance down there, but as you can see, plenty of room. Price is way far away from those levels, so no need to draw them for the time being. Now let's zoom in a little bit more. We used to have a trend line there, but also got broken and broken once again, so we should take that off. We have an outer level, an outer trend line there, but as you can see, price has not taken out the previous swing high in this trend, so the trend is so far in a halt. Okay, the trend is more or less sitting on standby, so to speak, and therefore this trend line is not really that strong. Okay, and well, price right now, we can see how the market, the price action reading is actually a little bit confusing. We have that former swing high, and then we scored a lower swing low, and then a lower swing high, and then a higher swing high. Price forming some sort of a double bottom there. And in price finding again resistance of this area, more or less, okay, coming back down. And all in all, we don't really have any bias here. Okay, it's a rather confusing price action. Price not really moving away from this area. Once we actually wait for price to break away from this congestion area, then we will be able to have some area free of traffic. All right, both above the range and below the range, there is not really any traffic going on in there. Okay, but as long as price remains in this area, right, especially in this middle part of the range, it's just best to not search for any trading opportunity at all. Okay. One final example, sterling pound against the Japanese yen, also weekly time frame. I'm gonna conduct this exercise very quickly here. If I zoom out, well, let me zoom out a little bit more. That's the beginning of the trend there. Well, obviously we can define an outer trend line in this downtrending price action. Okay. We here do have a bias from a long-term perspective. Please mind that I am zooming out my charts quite a lot. All right, level of resistance in there, price far away from there, so I will not mark it. Level of support in there, let me mark it with a horizontal line. There we are. Now we also have a level of support with this double top just above current market price. Okay, those are in this last swing. All right, these are the extremes of the swing. Okay, if price breaks out to the upside, this downtrending price action will be over. If price now keeps on pushing to the downside, well, this should be our next level of reference. Okay, now however, if I zoom in, I can see how price as of lately has kind of been moving sideways within a no man's land. All right, no clear price action reading as of lately, as of the last, let's say, 20 bars. All right, price simply flapping sideways. Moreover, again, we had an up channel there, probably the retracement of this. Let me zoom out once again. The retracement of this last swing. Okay, but then it kind of failed to keep on pushing to the downside. All right, instead we had the retracement, and then price simply flapped sideways for quite a while. So we can define our no man's land in there. All right, no man's lands in there. I'd like to see a breakout here to the downside. Why is that? Because if we break to the upside, we will be facing resistance rather soon. Okay, so yeah, maybe we do have some pips here. I mean, some free room here to score a profitable trade in there, which we may have, but I would like to see a breakout to the downside. Not only we have more free room here, okay, there's certainly less traffic in here to the downside than to the upside, but also, again, zooming out, we can see how the overall bias in this price pattern, in this chart, in this market, is obviously to the downside. Okay, price has been zigzagging to the downside, and therefore the bias is south. Okay, is to the downside. So if we mark our congestion area there, what I would certainly like to see is that breakout to the downside. Also, if we break to the upside, we will be facing that outer resistance. Okay, sorry, that outer trend line. All right, so I would be very, very, very hesitant to trade any breakout to the upside. If I was to trade or to search for long opportunities on this particular currency pair, it would be if I get a breakout of this level, also a breakout of that outer trend line. Why is that? Because here we have no traffic whatsoever. Do you guys see that? No traffic. The next level of resistance is this former level of support there. All right, there, but plenty of room here to score profitable trades. Okay, so my idea here, either breakout of this level here up there to search for trades in this area completely free of any traffic. Do you see how there is no level of resistance anywhere? All right, the trend line comes in there. Once it gives way along with that swing high, there is absolutely no traffic whatsoever in there. Same thing here, get a breakout to the downside, no traffic in this area. That's a beautiful area to search for short opportunities. As long as price isn't trapped within this area, that's a no man's land. That's not where I want to trade. Okay, now let's move on with the presentation. Now that these three commandments are rather clear, we need a market bias, and we should avoid no man's lands in order to trade in areas free of traffic. Okay, next point, buy off support and sell off resistance. This is like the top most important thing as far as support and resistance trading, meaning whenever you find levels of support and resistance, let's assume, for example, a level of support, okay, price having broken a level of resistance, once it comes back to retest that level, well, you want to be searching for buy opportunities of that area, okay, buy price patterns in order to go along on that particular currency pair. All right. Same thing the other way around. If you have a level of support, of resistance, I don't know, let's assume price has been uptrending, okay, finds resistance of that level. Once it comes back to retest that level, unless you get a breakout, okay, unless you get a breakout and then a retest, and then you would be effectively buying off support. Unless you get that breakout, what you want to search until that breakout actually happens, you want to be searching for short opportunities, because you would be trading against, you would be selling off resistance. All right, remember, buy off support, sell off resistance. And conversely, the opposite holds true as well. You don't want to sell against support, and you don't want to buy against resistance. If you have a level of support there, all right, a major level of support in there, price is somewhere in there, and you get some sort of a sell opportunity at that point where support it's nearby, you don't want to take that sell signal, because you would be selling against support. You don't want to do that, guys. You want to buy of support. You don't want to sell against support. Okay, same thing, resistance, price being just below resistance, you get a buy signal as per the price patterns we will see on a future video. You don't want to take that buy order, all right, because you will be effectively buying against support, and you never know. I mean, price might indeed find resistance of that level. Once again, you get a reversal, your stop loss gets knocked out. That's not a good idea. You don't want to search for buy opportunities until price gives us a breakout. All right. Let me give you a fantastic example that's actually happening right now on the euro against the Canadian dollar weekly time frame. All right. So we can see right there, we see a no man's land. All right. Price being moving within this congestion area, which in fact has the shape of some sort of a triangle. Okay, a leaning triangle to the downside. with price bottoming out at that level, maybe waiting, and maybe we would be waiting for a breakout in order to search for short opportunities. However, if we zoom out a little bit more, we can find how, or we can see how price has actually, well, given us a support point, a swing point in there, all right? This being the previous support level. Whoops, let me just be accurate with my trend lines there, guys. All right, with that double bottom there, that was the leaning triangle, that I was mentioning before. Unless you have plenty of pips here to search for potential short opportunities there, all right? Otherwise, it might not be a good idea to search or to find any or to trigger any short opportunity you may get up on that breakout if you have a further level of support immediately below entry price. All right? Assuming we get a short opportunity there, do we really want to take that short opportunity knowing that, well, shortly after we are gonna hit another support level? And in fact, take a look at what's going on here. Price is already finding support. Do you guys see that? Price is already finding support and already bouncing off that level. That's precisely why you always want to take a quick look into the longer time frames, or to simply zoom out into your charts just to verify that you are not going to find traffic. Remember, traffic, further levels of support and resistance ahead of your entry. Once this level gives way, the next significant level is down here. Here we have plenty of room to search for trades. However, here, well, it would be a tough call because we have further support levels, and remember, you don't want to sell against support, you don't want to sell against resistance. Another prime example, euro against Australian dollar, weekly time frame. Nice downtrending scenario, isn't it? We do have a market bias there. However, in here, price entered a period of another no man's land where price has found double support in there with that swing point there and that swing point there. Maybe we see it better on the daily time frame. Let me scroll forward. All right, that's the double swing point. So we would be tempted to, okay, that's also finding resistance in there, so we would mark that level. And if we get a breakout to the upside, we will search for long opportunities. If we get a breakout to the downside, which is what eventually happened, we would search for short opportunities in there. However, now let's zoom into the weekly time frame, actually the monthly time frame. Do you see what do we have just below that breakout point? Check this out, guys. Massive level, all right, a massive level of continuous support around the 156 area. All right, support, multiple bars bottoming out at that exact level. If you get a short opportunity there, well, I guess it all depends on whether you have enough room to search for that short entry, but again, please mind that you would be trading against traffic, okay? You would be selling against long-term support. Not a good idea. In fact, see how price touched that level, all right? Touched that level there, and now it's retracing back up. We may see that better on the weekly time frame. You see? Touched that level, and now it's come back up quite a bit, all right? So again, always take a quick look into the longer time frames. Whenever you find a trading opportunity, let's assume you find a trading opportunity on the daily or the weekly time frame, always zoom out into the monthly time frame just to confirm that you are not about to sell against long-term support or buy against long-term resistance. This is going to keep you away from troubles a number of times. Okay, sometimes you find a profitable trading opportunity or what it seems to be a valid trading opportunity, but then once you zoom out into the longer time frames, such as in this case, well, you see, hey, careful here, I'm about to buy against long-term support. Course of action, obviously, what you want to do is to wait for price to actually break through, and then here is where you can search for your short opportunities. Free traffic here, guys. I mean, no traffic whatsoever, okay? The chart is clean, below that particular level. There is nothing here to stop price. Once the breakout takes place, there is nothing to stop price to plummet below, and that's where you want to search for your short opportunities. And well, that links with the next point in the presentation. The longer time frames or levels of support and resistance on the longer time frames are always more significant than those on the shorter time frames. All right, that means that if you get a signal on a shorter time frame, and then when by zooming out in your charts, you realize that that signal contradicts the outlook you see on the longer time frames, you are usually better off not taking that trading opportunity. In my experience, whenever two contradictory signals clash onto each other, one coming from the longer time frames and the other one from the shorter time frames, about 70% of the time the longer time frame prevails. Okay, that means that by just avoiding taking trades that contradict the longer time frames, your win-loss ratio in the long run, all right, your win-loss ratio will benefit from this very single principle. All right. So going back into the previous example, if you remember, we saw a breakout to the downside on the weekly time frame, but then we took a quick look into the monthly time frame, and we saw that just below that breakout point we had a massive level of support on that monthly time frame. All right. So since the longer time frames are more significant than the shorter time frames, and you do not want to favor that shorter time frame against the longer time frames, well, obviously that's a trading opportunity you want to pass on. All right. So here's my advice, guys, to wrap it up a little bit. Whenever you find a trading opportunity, always zoom out in your charts. Okay, that's gonna take just 10 seconds. It doesn't take more than 10 seconds. Okay, so whenever you find a trading opportunity, zoom out into your in your charts, zoom out into the longer time frames, and confirm that you are not about to sell against support or buy against resistance. Again, you want to sell off resistance, you want to buy off support, not the other way around. This time, in this particular case example we saw 2 minutes ago, we got a sell opportunity that was facing long-term support. You don't want to sell against support, especially you don't want to sell against long-term support. All right, again, this very single principle will increase your win-loss ratio in the long term by up to 20%. All right, so please always, before pulling the trigger, just take a quick look into the longer time frames and confirm you are not about to get into troubles. Okay, I'm gonna keep the next point very short and sweet because it's very easy to understand. Pick the right time frame, guys. That means that you are to search for trading opportunities, meaning you are to search for the price patterns we are about to see on a future video. You should be trading or searching for those price patterns on the same time frame where you draw your key levels of support and resistance. For example, if you spot on the monthly time frame, you spot a key level of support and resistance, let's assume a previous swing low. All right, a previous swing low there, and well, next time price comes to retest that level, or even if it breaks below that level, and then price comes back to retest that level from below, well, at that junction of the chart, that's where you search for our trading opportunities, correct? For the price patterns that we will see on that next video. Well, you are to search for those price patterns also on the monthly time frame. You don't want to be zooming into the shorter time frame. Some people make the mistake of zooming, into the daily time frame, for example, right there once price hits that level, to how would I say this, to sharpen up their entry point. All right, and as much as possible. Well, that's a mistake. The reason for that is because whatever happens on the daily time frame is just too short of a time frame to be significant to whatever is going on the monthly time frame. If this level of support or resistance is or belongs to the monthly time frame, then the trading opportunity should belong to the monthly time frame as well. If you zoom into the daily time frame, you're gonna get too many fake trading opportunities, too many of them. All right, because again, you are micromanaging your trade. That's like zooming into atomic level, all right? and that's not a good idea. Okay, keep things in perspective, guys. If the trading opportunity, if the frame of that trading opportunity, meaning the map, the mapping line, the milestones, the levels of support and resistance belong to the monthly time frame, the trading opportunity itself should also belong to the monthly time frame. Okay, so obviously, conversely, if the trading opportunity, if the level of the trend line, the horizontal level of support and resistance, the range boundaries, whatever it may be, belongs to the daily time frame, you are to stick to the daily time frame as far as spotting the price pattern as well. All right. Okay, next one up, the sharper the level of support and resistance, the better. On a previous video, I was mentioning that sometimes those key levels of support and resistance are not actually levels, but rather areas. All right, rather areas. How is that? Because sometimes price doesn't quite always, let's assume, a triple top. Okay, price doesn't quite always. The markets are not perfect, and you cannot align the triple top in at one specific level, meaning with one single horizontal line. In fact, sometimes you get some sort of, something like that, where price is not quite topping out at exactly the same level, but at any rate is indeed topping out at one specific area. Well, while that's ultimately true, all right, while sometimes we cannot define one specific level as support and resistance, but rather an area as a whole, well, the sharper that area, right, the sharper that level of support and resistance, the better. And that's because of something that we already talked about on a previous video. The markets are made up by people, all right, and the reason as of why levels of support and resistance are actually significant is because those people are locating their trading volume, their trading tickets, right, their trading orders around that area. All right, so if we have one specific level, very accurate, very sharp level of support and resistance, well, all the traders around the world will mark that specific level, and therefore they will locate their trading orders either for bounces or breakouts. Well, they will locate their orders more or less pretty accurately, pretty tightly, so to speak, around that specific level. However, if instead of one specific level what we have is a wide area, well, those trading orders will be located or will be spread out around, or within that area. They are not going to be located around one specific level, but rather, you could see those orders, spanning for a 50 pip range, all right, depending on how wide that particular area is. But again, the sharper, the better. And the better, it is indeed better because the consequent move, once price hits and reacts off that level, again, either the bounce or the breakout, the consequent move is going to be much more violent or driven in momentum if the area is sharper. Again, because all those orders are going to be triggered at once, and therefore the market reaction, it's going to be massively quick. However, if those orders are spread out, again, in a 40, 50 pip range, 30 pip range, whatever wide it may be, then those orders are not going to be triggered at the same time, right? No, they won't be triggered at the same time, and therefore price will indeed react off that area, but not as in as much as momentum. Okay, so it's always much better to any trading opportunity you may find around a sharp level of support and resistance. It's going to carry a higher degree of quality as a trading signal, and therefore the market reaction, the win-loss ratio you're going to get on that signal is going to be higher than if you are trading off a wide area of support and resistance. Okay, always keep in mind that the sharper the level of support and resistance, the better. Again, let's go back to a previous example that I showed you guys a few minutes ago. Remember this setup on the Canadian dollar against the Swiss franc? Do you see how price is not lining up at the exact same level? All right, it's more or less of an area, all right, of resistance. This one there, that one there, that one there, that one there. Well, we have some sort of an area of resistance there. Next time price comes to retest this area, we are not going to be able to specify right to the pip where we want to search for our consequent trading pattern in order to trigger our entry. It's going to be a wide area. And again, any trading signal we may get right off that area, it's just not going to be as cut clean. Okay, it's just not gonna have that mint perfect condition, and it's gonna be difficult for us to pinpoint the exact entry level. All right. In the other hand, such as for example what we are seeing right now on the euro against the Japanese yen weekly time frame, do you see how we can really nail down the range boundaries right to the pip? Okay, once, twice, 3 times, 4 times there, once, twice, 3 times there. Do you see how all the different highs and lows can be defined with a rather sharp straight line? That's the ideal situation here, guys. Why? Let me actually mark that with an actual horizontal line there. All right. You see how they touch right to the pip, all right? Right to the pip. So now that we are getting the breakout, this is going to be an ideal location to search for trading opportunities, because we can really nail down the key level of reference, and therefore any trading opportunity we may get right off that area, our entry point is going to be perfectly sharp, okay? Perfectly defined, and as a result, all right, they either if we get now a breakout or a fake breakout and a bounce, which is a setup, a trading pattern that we are going to see on a future video. As I've mentioned over and over and over already, I know about that. I apologize for that. But again, you've got to, we've got to build up on the theoretical knowledge here before we actually get onto the trading patterns themselves. So now, even regardless of whether this breakout pulls through or we get a fake breakout, we'll have to wait for this live bar to close in order to know that. But like I say, whatever trading signal we get right now of this trading pattern is going to be a fantastic, all right, a fantastic high quality trading opportunity. All right, so please, if you find this type of very sharp and very accurate levels of support and resistance, such as in here, all right, do keep an eye on that, guys. Do keep an eye on that, because whatever price reaction you get off such a sharp level is going to be a high, or it may potentially become a high quality trade with a high win-loss ratio. Okay? Okay, next point up, and now we are nearing the end of this presentation. Horizontal levels of support, and this may come as a shock for some of you, horizontal levels of support are more significant than diagonal levels of support and resistance. All right. What does that mean? Well, it means that any trading opportunity you may get of a horizontal level of support, right? Let's, for example, a swing up that comes to retest a former level of support, now it may work as resistance. Well, any type of bounce to the downside that you may get off that level is going to be more significant or a higher quality as a trading setup in itself. All right, it's going to carry a higher degree of win-loss ratio, a lower degree of risk. However you want to put that, you get what I mean. Well, that's going to carry a better chance of success that if that trading opportunity comes from a trend line. Okay, obviously diagonal levels of support and resistance are trend lines. All right, so if you get a trading pattern of a diagonal level, of a horizontal level of resistance, support and resistance, is better than if you get it off a trend line. Okay, the reason for that is again the pretty much the same thing as what we've been talking about over and over throughout the videos. Levels of support and resistance are only significant if a number of traders are locating the same level on their respective charts. The thing is that trend lines are a rather personal thing, all right? They are like perfumes. Not every single person likes the same type of perfume, right? Well, trend lines are pretty much the same thing. If we have a zigzagging price action, right? Something like that. Well, some people, such as myself, only draw the outer trend lines. Some others draw also the inner trend lines, okay, linking the beginning of the trend and this inner swing there. Some of the people draw trend lines within the swing, all right, such as here, beginning the trend in there. I mean, trend lines is not as universally accepted. All right, they are not as universally accepted as horizontal levels of support and resistance. If in your chart you have something like this, well, you know where the swing points, the swing turning points are. This one, this one, this one, this one, and this one. All right, there is no discussion about that. All right. However, again, if you have a zigzagging price formation in one given direction, then you can draw multiple trend lines in that trend, okay? And therefore, you never know which one is the one that the majority of the traders have chosen. Most of them only mark the outer trend line, and that's why I personally only mark the outer trend line, okay? Because it's the one most commonly accepted, all right, as a level of support and resistance. However, again, different traders, different trend lines. Levels of horizontal support and resistance are much more universal, easier to spot, and therefore the market reactions you get of a swing low, all right, obviously a major and easily identifiable swing low, well, everyone has marked that particular level on the chart, and therefore the market reaction is just going to happen in higher trading volume. And as we all know already, the higher the trading volume, the higher the market reaction, the higher the momentum of one particular level, the better the chances that that trading signal is actually going to be successful. All right. So again, as a general rule of the thumb, always favor trading signals that happen off at a horizontal level of support and resistance than those happening off diagonal levels of support and resistance. Okay, again, it's a statistical thing. You will score higher win-loss ratios on the long run if you favor horizontal against diagonal levels of support and resistance, or rather trading setups happening off horizontal levels of support and resistance than those happening off diagonal levels of support and resistance. So if you have, and I just want to wrap this up real quickly here, if you have two different trading setups, let's, for example, I don't know, the euro against the American dollar, and another one happening at the same time on the euro against the Japanese yen, for example. All right, euro against the Japanese yen. And one of them is taking place off a horizontal level of support and resistance, and the other one is taking place off a trend line. Always favor, if you have to choose one, all right, if you want to go for just one of them, all right, in order to, not overexpose your trading account to euros, all right, you don't want to trade, as a general rule of the thumb, you don't want to take multiple simultaneous trades involving currency pairs on the related to the same currency, in this case the euro. Okay, you usually don't want to do that. Okay, you want to diversify your risk. So if you take one trade on the euro against the American dollar, you may want to pass on any upcoming trade that may happen on any other euro cross or any other American dollar cross. All right, so if you have two different trading setups happening simultaneously, always favor the one happening off a horizontal level of support and resistance. All right, enough about hitting or beating that horse. Let's move on with the presentation. And well, finally, to finalize this particular presentation, I'm just gonna blend these last 2 points because they are mostly related to the same thing. Be selective with your setups, and you're gonna see why on the very upcoming video. We are gonna be talking about that specific point, and if you don't see it, it's just not there. I'm talking obviously. I'm talking about levels of support and resistance. Obviously, if upon opening your any particular forex chart for any particular currency pair on any particular time frame, if you do not see the levels of support, the significant levels of support and resistance within the first 10 or 20 seconds, then it means that they are just not there, or whatever level of support and resistance there may be, it's just not going to be as significant. Remember that setup I showed you guys before about 5 minutes ago on the euro against the Japanese yen weekly time frame, where we identified a nicely clean cut range with easily identifiable range boundaries, the resistance boundary on the upside and the support boundary on the downside, or to the downside. Do you remember that one? Well, I am sure anyone who's remotely familiar with support and resistance could define those two key levels within what? 10 seconds? 20 seconds? You don't really need more than that, okay? The most beautiful and the most accurate and the most significant levels of support and resistance, meaning the levels of support and resistance you actually want to trade off, well, those ones, they stand out of your chart like this fast. All right, those are the most significant ones. Those are the ones that most traders around the world are going to be locating their trading volume around, and therefore those are the ones that are going to give you the setups, the opportunities with a higher quality degree, with a higher degree of quality, all right, or with a lower degree of risk. All right, so again, if you need to stare into your chart for more than that, 3-4 minutes, drawing dozens of lines and etc., then the trading opportunity is just not there. All right, you need to appreciate, or you need to I would say appreciate the beauty of a trading setup, the simplicity of a trading setup. Those ones are the ones that, trust me, in the long term are going to carry better results in your trading. All right, so you need to be selective and only pick those charts that gives us those sharp levels of support and resistance in order to base our setups, our trading opportunities around those charts. Okay, and again, I'm going to be talking about that on the about this particular point on the next video. Now, guys, please write down these 10 commandments on a piece of paper, okay, on a sticker, and stick it next to your monitor. And next time you draw your key levels of support and resistance on your chart, please go through this little list. All right, that's gonna take just 1 minute, and if you can fulfill them, it means that that's a valid trade, and you've got the green lights to search for trading opportunities of that particular level and of that particular currency pair. All right, currency pair and time frame. All right, folks, that's all for this video. I'll be waiting for you on the next one. Cheers.